So there's a few things that we're looking at today. I would tell you, let's just start real quick with the election. I know everybody's got that top of mind. The election, honestly, as it relates to the markets, really does not matter. There are some other things that matter, and we're going to talk about some of the things coming from the election and potential policy that we'll see going forward. But as it relates to the markets going up, we're going down. Typically, what's happening in Washington, D.C. is not a big driver of that. So what is a big driver? Really three things, as you can see at the top of our screen here. The labor market, which is essentially you and me, the consumer. How are we doing? Which typically drives growth in this economy. We'll talk about that. The second big thing is inflation. And then the third thing, being driven by the first two, monetary policy from our Federal Reserve, which is our central bank here lower. Before we jump into those three things, I wanted to show you all, there's a couple different ways that we can look at the markets, a few different lenses, if you will. The first lens would be this big, long green line that's the less volatile. This is a secular time horizon. This is anything that could take place over the next 20, 30 years. We would like to position our portfolios to take advantage of all of these things, and we would like to, as Fidelity, to spend a lot of time on this space, but there's really no need to. Y'all already know a lot of these long-term trends. Growth in middle-income houses across emerging market nations, aging demographics, not only here domestically, but internationally. And while we want to take advantage of these things, it's very hard for us to keep your statements away from you for the next 20 to 30 years while these things play out. So we can't just focus on the secular. Another one that we could focus on is that gray line that's extremely volatile. It's the more tactical time period. These are things that are happening over the next 1 to 12 months. But the reason why we don't focus here is because it's already a very saturated market. Wherever you get your news from, Fox News, MSNBC, CNN, CNBC, Bloomberg, they're already covering this stuff. So it's a very saturated market and very little that Fidelity can do to add value. So where do we try to focus? It's on that intermediate time horizon, what we call the business cycle. And what we've tried to do here is to dictate that. Sorry that that's not lining up. There we go. With this pictograph. For anybody that joined us last year with Dr. Klaus de Wilt, I'm going to introduce this to, or you may recognize this. For those of you that you're brand new to this, let me explain it real quick because it's very easy to understand. And as they say, a picture says 1,000 words. So what you're looking at here is macroeconomics 101, right? There are 4 different phases of the business cycle. There's the early part of the cycle, the mid part of the cycle, the late cycle, as well as the recession. And what we have done, there's this gray line that sort of bisects the pictograph. The pointer doesn't work on the TVs. That's good to know. But essentially a gray line that bisects the pictograph. If you find yourself above that, your country's expanding. If you find yourself below that, your country's contracting. And then we've overlaid all large developed and developing nations to show you where they are relative to their own business cycles. So a lot of people look at this and they look at that first half of the chart where China's on the left-hand side, and they look at it going up, and they imagine that being paved with rocks and boulders. It takes us forever to get up to the top of that pinnacle. And on the other side, on the back half, they imagine it being paved with ice, and once you're on the backside, you just slide down into a recession. And that's not the case at all. For anybody that was with us this time last year with Dr. Klaus de Wilt, you actually saw the U.S. more in late cycle dynamics. We've actually come backwards recently. Manufacturing activity has picked up here in the U.S. The consumer is coming off of a very, very strong reading overall in terms of its health. So things here in the U.S. overall are very fine today, and we're actually pretty optimistic going forward. I would caution you, there are some countries, though, that are moving more into a late cycle or even potentially in the early parts of the recession. Not to say that it's going to be a terrible thing for these economies. There are a lot of times there are many great companies that operate in these countries that have very little to do, their growth at least, to how the country is doing from a relative growth standpoint. We'll talk about some of the opportunities that we're seeing there. But again, as mentioned earlier, as it relates to the U.S., really 3 things that matter. Not so much the election, but what are those 3 things? The consumer, inflation, and the actions of the Federal Reserve. So let's dive in. As it relates to the consumer, we're coming off the healthiest readings we've ever seen. Unemployment rate, you can see on the far left-hand side, this was all through May 2024. That has come up a little bit since then, currently sitting at 4.2%. You might say, Rob, that ain't so good. Higher number on unemployment? I don't like that number at all. We got to ask, why is that number going up? Is it because the demand for labor is going up or down? No. It's because more people are coming back into the labor markets. That's a good thing. That's a very healthy sign for unemployment rate. Additionally, you look at how overall consumers are doing. Let's press the reset button. Go back to the pandemic. What did we all do to the pandemic? Was anybody traveling like crazy that year? No, unfortunately we couldn't, right? So what did we do? We gave Amazon some of the best numbers they've ever seen because we were ordering so much from them, right? We really spent a lot of money on goods. Not only that, what happened during that time period? Interest rates, did they go up or did they go down? Yeah, they went down. So anybody here have a mortgage? Anybody refinance that mortgage around 2020 or 2021? Right? That's what the majority of Americans did. So you look at the overall household balance sheet health, it got a lot healthier. Overall liabilities from a household balance sheet standpoint went down, while assets on the other side went up. We accrued over $2 trillion of savings nationally during that time period. So overall total assets minus total liabilities going back to 2019, that was measuring at about $110 trillion for the U.S. consumer just across our country. As it sits today, we're sitting at about $150 trillion of total net assets. We're actually sitting in a really good position now. Liabilities are still low. Anybody here moving? Right? Very few people. Why? Because our liabilities are so low. Either that or we paid off our house and we don't want to pay the higher interest rates. So people are actually doing quite well. Now, there are some structural issues that are starting to kind of create cracks in the system. Anybody pay attention recently? Target came out with their earnings. They said people are actually choosing to go to Walmart over Target. Additionally, IKEA came out with their earnings and they missed. They said that the consumer, or at least the consumer that purchases from IKEA, is deciding not to spend money at IKEA and only spend money on the necessities. So there are some lower parts of the overall consumer base that are starting to feel it a little bit as it relates to the higher inflation, which we'll talk about here in a minute. But on the whole, you're seeing consumers broadly doing just fine, and they're still spending money like crazy. Denver International Airport had the busiest travel season ever recorded for its Labor Day weekend a few months back, and one of the busiest travel seasons ever recorded for Thanksgiving last week. That's not happening just here in Denver. That's happening across the U.S. as well. Additionally, unemployment, more people coming back in, sitting at 4.2%. There's still more jobs out there than we can fill with people, and they're making more money. Wage inflation today sits at around 4%. Inflation today sits at about 2.5% to 3%, depending on the metric you're looking at. So you net those out, people are still making more money net of inflation, which is one of the reasons why we think inflation is actually going to be stickier for longer than many people anticipate. What you're looking at in this chart is CPI going back to January of 2021. You could see that during the pandemic, that increased dramatically because of all the spending that was taking place, all the money printing that was taking place to bridge the gap during that very uncertain time of the year. And if we take a closer look, well, we'll get to that in a minute, but one of the things you'll notice here is that we've really recovered from that quite dramatically. We've come down from the 9% levels that we were in the mid-2022s, and we've evened out around 3.25, depending on the metric you're looking at, 2.5 to 3.25, really. The problem, ladies and gentlemen, is not this blue line, but the lines coming off of it. So you have a dotted blue line that's at the very top. This is our assumption. Should we see commodity prices go up by 30%? The dotted purple line on the very bottom, which is an assumption if we see commodities to decline by 30%. The solid purple line, which is market expectations, and then you see this green line coming, which is in between the other lines. That's Fidelity's estimation going forward. The big reason why I want to drive your attention to this is because we actually anticipate inflation to remain rather sticky relative to what the market anticipates. If inflation is stickier, why do I bring that up? Because of that third thing, the Fed, it could handcuff them from cutting rates as quickly as the market's anticipated. Oops. What you'll notice here is the chart on the left. You'll see the incredible rate increases that we saw during 2022. The fastest rate increase cycle we've seen going back to the 1970s. Quite incredible. We meandered around the 5.25% after that fastest rate hiking cycle since the 70s in over 50 years. And what do we know that happened in September of this year? Fed dropped rates by about 50 basis points. Then followed up with that in November by another 25 basis points. It's anticipated a week from today that they're going to decrease by another 25 basis points. Now, the reason why they're doing that today is because we're getting a lot of the lows on the inflationary data because of last year's numbers. It's a year-over-year measure. So if you had really high inflation last year and really low inflation this year, it looks like you had a big improvement on a year-over-year basis. But in reality, if you had lower inflation last year and you're comparing that to lower inflation this year, you're not making as much progress, or at least that's how it seems. And so under our estimation is that as we start to see inflation actually trickle up a little bit, that could handcuff the Fed next year. Right now, the market's pricing in 4 rate cuts next year. We don't think so. And ladies and gentlemen, I got to tell you something, that's a good thing. You see the Fed cutting and cutting more aggressively than what they anticipate, that means something's wrong with the economy. And there's nothing that is dramatically wrong with our economy today. There's definitely some things that we're looking at, some things that we're watching, but overall, we're coming off of some of the healthiest levels ever recorded here in America. So overall, Fidelity is actually pretty optimistic as to where this economy is. And I would not be surprised if we all get together this time next year and we're looking at something very similar to this chart right here, where the U.S. is teetering between mid and late cycle dynamics. And for those of you who invest in the equity markets, that should be a very good thing. This typically means let's be risk on. There's only one time period across these 4 different business portions of the business cycle that equities produce a negative return. Anybody guess what that is? I heard it early. It's actually recession. The recession is when equities, and this analysis goes back to the 1950s, your equities produce a negative return. But the great thing about working with RWP is that you actually work with a time-weighted asset allocation portfolio. So you're going to do great during the early cycle, which is when your stock returns are the highest. You're going to have great returns in the mid-cycle, which is when your stock returns are the second best. And you're going to have great equity returns when when we're in the mid-cycle, because that's the third best time to be in the equity markets. Additionally, because of the insurance that you hold, because of the fixed income within some of the portfolios you hold, that's typically does best during a recession time period. So while we're really optimistic right now, and I have a chart in here, I don't want to get it too complicated, but if we look at all the different categories of equities, both domestic and international, right now Fidelity is optimistic on 3 of 5 and neutral on 2. If we were to look at the bond side of the equation, we're neutral or negative on 5 of the 7 of those, which again should be a good thing. We want to be risk on right now. We don't want our bonds to work. We want our equities to work. And despite whatever you're hearing in the news, I'm telling you right now, your equities will continue to work, barring we see something that the global economy does not foresee coming. And there's plenty of those things going on right now. Things like the wars across in the Middle East, Ukraine and Russia. Well, y'all are familiar with these. So let me take a step back. Any questions on this before we transition over to some of the policies that we could see from the next administration? All right. Silence is golden. So, in a very professional sense, I put this together and broke down some of the biggest policy, potential policies that we could see from the next administration into these 6 categories. We could talk about them all. We can talk about a couple of them. But the reality is there's still a lot of ambiguity as to what to anticipate from this going forward. We can chat through tax policy. I know trade and tariffs is definitely a big issue. That's one of the biggest issues that we come across in all of my meetings. But what you will find throughout all of these is we will see is the final answer. Because it's still not January 20th. Nobody's been sworn in to be the next Director of National Health, or Director of Energy Services, anything like that. There haven't been any official appointments yet. And for anybody to take any of the election rhetoric thus far and take that as the word of God it's a fool's errand, because there's a lot of promises that are made and a lot of things that are brought up along the path to Washington, D.C. that many times don't actually come to fruition. So let's actually take a look through a few of these, and I would love to hear from y'all too. What else is top of mind? Start with tax policy. Currently, the market is anticipating that we see a continuation of the Tax Act and Tax and Jobs Act that was passed back in 2017, which is set to expire at the end of next year, extended. Additionally, we could see corporate taxes at 21% today potentially come down. Market seems to be pricing in about 17% corporate tax rates going forward. Individual tax rates could get as low as about 15%. We'll see what happens there, right? There's 2 sides of the equation. How much money are we bringing in versus how much money we're going to spend? For anybody that's paid attention to politics, you know that the U.S. has not had any problems with the latter part of that equation, but it's been the earlier part of that equation that's been the big question mark. We'll see what happens there. Capital gains is another thing that Trump has at least alluded to, or the Trump administration has alluded to, decreasing to about 15% going forward. All of those things would be very advantageous to the equity markets going forward and could push valuations even higher. as we look to trade and tariffs overall. Relationship with China, which is the big one. This is something that definitely bears watching going forward. In our opinion, it's really going to come down to what kind of Trump or Trump administration do we get? Do we get Trump the deal maker or Trump the authoritarian? So far, we believe that we'll see more of that Trump the deal make. As it relates to China, they're our biggest threat as it relates to overall global growth and becoming the hegemon country that's sort of in charge of everything. The problem with China today, they're in a huge trust deficit. You recall back in 2020, they reminded the global economy how communistic they were in a very quick fashion. Jack Ma, who was the CEO of Alibaba, a very big company over there, went missing after questioning the authority of the regulators for over 6 months. Just completely disappear. A very prolific person in the news almost every single day, just went missing for 6 months. Not only that, they took many of the wealth from the companies over there like Tencent, Alibaba, as I just mentioned, DD.com, JD.com. These incredible corporations that had implored capitalistic policies, and it seems dramatic success because of those policies. They took the much of the wealth that had been created from those corporations and redistributed it to the constituents of that country. So we'll see what happens with China. What I would tell you is a lot of people are concerned about the 10 to 20% tariffs that come from everybody. In our opinion, this is a trade negotiation to get people to the table. Hypothetically, let's say it actually goes into fruition. Some people to come to the table, some people do not. What we anticipate to see is something very a la 2016 to 2020. While we saw prices go up in select areas, generally speaking, prices didn't go up dramatically by any means. So what did take place? You saw a reorganization of supply chains. In 2018, Brazil was the largest importer as well as exporter of soybeans. Brazil has zero agriculture dedicated to soybeans. So what was happening? U.S. is taking all of our soybeans we grow here, exporting it down to Brazil, who was importing it, and then exporting it over to China, who was then taking many of their goods manufactured over there, sending it to Brazil, who was exporting it to us here domestic. So you could see a reshuffling, if you will, supply chains, which is really what we saw throughout the 2016 to 2020 administration. But again, we'll see. Nothing has come about it yet. We won't know anything until we get at least 6 months into the administration. And additionally, I do believe that it's going to be not as impactful from an overall macroeconomic standpoint as what's it's being made out to be. Many people also ask, well, what does this mean for international companies? Well, again, we'll see. The tariffs would not be put upon those corporations to pay. That's typically for the importer to pay. And so it wouldn't hinder many of those corporations. Think of your like LVMHs of the world. That's Louis Vuitton, the largest luxury retailer out there. L'Oreal, another huge retailer out there. Nestle, a huge chocolatier internationally. They wouldn't be the ones burdening the tariff increases. It would be the importers. But again, in our opinion, you're not going to see the U.S. just paying 10 to 20% more on everything. We believe it's a negotiation tactic, and even for those that don't come to the table, probably a redevelopment of supply chains, which, like I said, is what we saw in the 2016-2020 administration. I'm going to pause there because I know this is the one that everybody wants to talk about. To see if there's any other questions, thoughts, respectively, before I move on to energy policies of the regulatory environment. Let's move on to energy policies. Traditional energy sources, so this is oil, natural gas. Quite candidly, they've been demonized over the last decade. So much so that we have underinvested in those industries in a quite dramatic fashion. And you may be saying, Rob, it sounds like you come from the South, having gone to Arkansas, but up here, we like our alternative sources of energy and not oil. And I'm completely with you. I think that not that we're going to see a future that has zero oil involved. I just think the conversation going forward is going to be alternative sources of energy, green renewables, and traditional sources of energy rather than just alternative. And I think a lot more are starting to come around to that. However, over the last 10 years, we've underinvested in that space. For instance, in 2014, we went through an earnings recession here domestically. We saw the earnings across the S&P 500 corporations drop off dramatically on the whole. If we look at it under a microscope, it was really the energy corporations that had their earnings brought down in a very dramatic fashion. So much so it pulled the entire S&P 500 earnings negative for the year in 2014, 2015, and they recovered in 2016.
Well, we see any renewed interest around nuclear in this country?
100%.
100%.
I'll get there in just a minute. So in 2014, the amount of investment that we put in, both public and private, to these large integrated, large E&P corporations was about 75% of what we had in 2013. Followed by 2015, another 75% of the investment that was put in the year prior. 2016, another 75% of the investment is the year prior. So by 2016, we were investing roughly 56% of what we had in 2013. Fast forward from 2016 to 2020, before the pandemic, we had recovered some of that. We had gotten back up to 60% of what we had invested back in 2013 into the traditional sources of energy. And by that, I mean the manufacturing of it. Are we still as efficient as we used to be? The transportation of it. Are we still as efficient as we used to be? The refining of it. Are we still as efficient as we used to be? Obviously not so much, but we had at least recovered 60% of that spending. During COVID, it collapsed. Only 25% of the spending that we used to dedicate to the upkeep in that industry was invested at that time period. So we're not nearly as efficient as we used to be. And as you're seeing with the geopolitical issues across seas, with the UK being more reliant on, saying they're going to ditch Russian natural gas, they haven't yet. They are going to be reliant upon U.S. natural gas going forward. And there's the combination over there that you could substitute natural gas oil. There's a lot of things that could go wrong. Fidelity's opinion is that going forward, we probably see oil prices and natural gas prices increase from here because something is going to go wrong and due to the lack of investment. However, it will be up to the alternative space to supplement that going forward as well. So, as it relates to Trump's policies or the Trump administration policies, seeing less regulation in the traditional spaces so we can get back to what we used to do, and increasing some of the regulation and increasing some of the, we're not just going to throw blank checks at the alternative space like we have. Going back to 2014, we've invested $700 billion in the alternative space. Back in 2014, U.S. was 80% reliant on traditional sources of energy. Any idea what that metric is today? 86. A lot of money's been thrown at it. We realize that it's not as efficient as maybe we once thought it was. There are still some flaws with it, and so we need to be looking at things like nuclear energy, which we had, again, demonized going back to the 80s with 3 Mile Island, Chernobyl, Fukushima over in Japan. There's a lot of red tape there. It's interesting. Corporations are now utilizing AI to get through a lot of that red tape. Microsoft, for instance, turned on the third generator from 3 Mile Island to help power some of its AI facilities, its data warehouses recently. Also, if you look into the history of nuclear energy, and this is getting off topic a little bit, but I would encourage you to do so, the way that we have been doing it with the nuclear reactor is the most dangerous way possible. This goes back to the Richard Nixon days. Richard Nixon had two options in terms of funding. He could send the funding to California, his home state, where they were practicing the traditional, what we know today as nuclear energy, via the nuclear reactor, or he could send that money to Tennessee, where they were practicing a different way to go about nuclear energy, what they call a Morrison salt core reactor, which doesn't have any of the pressurization that potentially leads to the nuclear meltdowns. Much safer way to utilize nuclear energy, but instead decided not to send it to the safer part because he wanted to help out his home state. So there's a lot of ways that we can go about this, and guess who's been going about it recently in terms of putting out a new nuclear generator almost every week for the last year? Nailed it. So we're falling behind in that space. We are realizing that, and I think in this next administration, I'm not sure you'll see a lot of nuclear reactors come up, but hopefully you'll see some deregulation come down in that area. It's where we can actually explore this without having to pay hundreds of millions or billions of dollars for lawyers to get involved and also slow us down. We want to go about it in a safe way. There are many safe ways to go about nuclear energy. Something to definitely watch going forward. Regulatory environment, I kind of alluded to it throughout the last three policies. Probably seeing this come down going forward overall. I think this really will help the financial sector specifically. You've seen that since the July time period. You've seen financials, industrials, these corporations that do have more heavily regulated provisions on their sectors really start to rally. As everybody know, going back to the Dodd-Frank Act, which was hashed out through the global financial crisis, big regulatory bill that kept banks from getting themselves into trouble. Again, very good bill. However, we've had zero regional bank creation going back over the last decade. Zero. We have no competition in the bank space. Why are money markets today yielding 4.75% and your savings account yielding 25 bips? Because there's no competition. It would be good for us to have a little bit more competition in that space so we can see some general efficiencies start to transact into the financial space. Government spending and debt. This really starts to get at the level where it becomes really ambiguous because we know that the overall administration wants to spend money. Both sides, both administrations who were running for president, none of them were talking about saving money. They were talking about spending money and getting more money back to the consumers. The big question mark with the Trump administration is this Department of Government Efficiency. So, take a step back. The estimates in terms of the increased spending on our budget deficit has been anywhere as low as about 2.5%, all the way as aggressive as about 11.5% over the next 10 years in terms of running an increased budget deficit. So the U.S. spending more money than it's bringing in. The Department of Government Efficiency, which is not going to be a congressionally appointed entity, it's going to be just a consultant, if you will. I've seen the estimates in terms of how much that they could save going forward, being anywhere between about a few $100 billion all the way to a few $1 trillion. Again, we'll see. But ultimately, we hope that the administration would realize that we need to stop spending as much money as egregiously as we have. I'm sure you've all seen this, that the amount of interest that we're paying on our debt has exceeded the amount that we spend on an annual basis on our defense. And it grows every about 100 days by about $1 trillion. Quite incredible, the amount of money that we're seeing. I'm happy to talk about that and the sustainability if there are any questions there. The last piece being Federal Reserve policy and inflation. Inflation is really going to depend on the amount of spending we do relative to the amount of money we bring in. I would tell you that I do anticipate with the amount of spending that we do see persistent inflation. I think I've already communicated that, not to say that we should be concerned by it, but rather than getting to the 2.5% level that the Fed wants to get to, anticipate us being around a 3, maybe 3.25%. Nothing so much to where it's breaking anybody's back. What broke people's back is when you see on a year-over-year basis, grocery prices going up cumulatively by 25%. Oil prices going up double, right? That's what really breaks the consumer's back. Not so much seeing 2 to 3% increases. And additionally, going back to that one chart I was showing, at some point in time, we will go through a recession. I encourage you to be excited for us to go through a recession. It's a cleaning out, if you will. Consider it like seasons. Spring is the early cycle, summer's the mid-cycle, fall's the late cycle, and recession's when it's at. Nobody likes going out and having to shovel really wet snow and having to bundle up to do that. You're exhausted. It's only 8 o'clock in the morning, and you got to put 2 kids together and get them to snow. It's chaotic in the wintertime. There's less light outside. But we have to go through that to get through spring. Same thing with recessions. Recessions just trim the fat, if you will, across the excesses of our economy. They are very healthy overall. And if you want to see inflation actually go down, or we actually see deflation, where you have a negative sign of inflation and prices coming down, we need to go through a recession. Unfortunately, we don't see that happening over the next 12 to 18 months, which is good if you're an equity holder and you invest in the stock market. But one of the last things I would say here is going to the election. I'm sure if you're distraught or unhappy about the results, I'm sure if you go back to 1980, what you would find is that there is some administration that you also didn't care for. My message earlier was that the markets don't care about who's in office. What they care about is uncertainty. We removed one of those layers of uncertainty with the election. And if you go back to 1980, when Ronald Reagan took over and served 2 terms, 8 years in total, was followed up by George H.W. Bush, then Bill Clinton in 92 years, then George W. Bush for 2 terms, 2008, then Barack Obama for 2 terms, then Trump for a term, then Biden for a term. There is somebody there that you do not appreciate or do not agree with their overall policies. Well, look at that chart on the screen right there. What does that show you? Sure. Doesn't matter. The markets go up. And for anybody out there that thinks, well, you know what? I'm going to get out of the market because I don't think it's really good right now. I'm going to wait for a better time to get back in. What I'm showing you with the bar chart on the right-hand side, let's say hypothetically you're the best trader in the world, right? Over the last 40 years, you've gotten it right every single time but 5 days. So if you just invested $10,000 and invested yourself that entire time period, you would have come out with over $1 million. If you just missed the 5 best days, that means you were right 99.997% of the time. You are the best trader in the history of trading ever. Your return decreases by almost cut in half. What is that, 31, 38%? I can't see from back there. 38. But either way, I think that seems incredible, carries incredible weight in his Utah message. Even if you go just to missing the best 30 days, which now you are right 75% of the time, still the best that has ever existed. You see what that does to your overall return. Ladies and gentlemen, this is not about, trying to time the markets. It's all about your time in the markets. We've gone through tax rates as high as upper 30s for corporations, individuals in the 70s. We've gone through much lower tax environments as well. These companies always figure out a way to make money. There are always loopholes. Why? Because many of these politicians play in those loopholes. There will always be loopholes. So I hope this provides some clarity as to what's going on. My goal, I know there's a lot of noise that's thrown on you through the news, but I hope this throws out the noise and we really concentrated on the news today. And the news being the consumer, inflation, and the Fed. All of those things really look to be on our side, or at least for risk assets, over the next 12 to 18 months. Happy to answer any questions or concerns you may have.
Please, have to rationalize the Warren Buffett, concerns, the Ray Dalio's concerns versus what you're presenting here. They're kind of ages.
Most certainly.
Disastrous pictures.
So help me out. I have not heard Ray Dalio's opinions. I would imagine Warren Buffett's opinion is that we get a little shocking. Yeah. So Kareem that doesn't know, over the last almost 12 months now, at the onset of 2024, Berkshire Hathaway had 2 very large positions in their portfolios, Apple and Occidental Petroleum. Fast forward to today, they reduced those exposures and are one of the largest holders of treasuries as it sits today. What I would tell you is go back to the advice that Warren Buffett gives. Don't try to time the markets. He is timing the markets as a spoon. Go back to 2007, 2008. He also didn't see that coming. He was heavily allocated to equities at that time as well. One of the most popular things going back to Warren Buffett during that time period was he was asked afterwards, 2010, 11, 12, 13, how did you not lose any money during the pandemic? During the global financial crisis. Anybody know what his response was? Did sell? Nailed it. Didn't sell. It only becomes a realized gain or a realized loss once you sell. But that's why we work with our financial advisors today, is to make sure we know we have a plan in place. We have cash when we need our dash. Markets are going to work for you time and time again. Here's another chart for you. This is going back almost 100 years to 1936, your average annualized returns. I always think about the equity markets like a contract. So one side of the contract says I'm going to get on average about 10% returns, but there's some things I have to put up with, right? There's some contractual obligations I've got to put up with. What are those obligations? Volatility. This is what normal volatility looks like going back to 1936. 3 corrections of 5% per year, 1 correction of 10% per year. That's normal. Additionally, a correction of greater than 15% every 3 years and a correction greater than 20% every 6 years. Not only that, so if we ever see volatility, just put a bow on that, that's normal. We should see volatility. If we're not, that's not normal. This year has not been normal. There's only been 2 time periods where we've seen close to a 5% pullback. In August, which was quickly eradicated, and in April, which lasted for a week. This has not been normal. Additionally, at the very bottom there, it says 75% S&P 500 batting average. What that means is going back to 1936, 75% of the time, the S&P 500 finishes higher on the year. Could you imagine going to Vegas and sitting at a table knowing that 75% of the odds were sitting in your favor? It's incredible. This is the power that we have with the equity markets. And heck, you might be saying, Rob, 1936, that seems like you're selecting some time period. You're forgetting the Great Depression and no do for 1820. We went back to 1920 picks, so even 10 years previous. You'll find that your average annualized return is still 8%, and your percentage probability of the S&P 500 being up is 73.9%. Still very much in your favor. And that 8% is still well above the assumed rate of return that our Resolute Wealth Partners, the planners, is incorporating in your financial plans. So I don't know why. There's plenty of reasons to be concerned there. However, especially as it relates to Warren Buffett, because Ray Dalio has owned hedge funds in the past, they're more tactical with their money. Warren Buffett's going against his first tenant that he owns, well, second tenant. First is for those who have no idea and are not working with a financial advisor, just go passive. And then the second piece of advice is don't find the markets. That's what So we'll see. We'll see how it plays out. But look, I would be even more worried right now if everybody was optimistic. And there's a popular saying, I can't remember what it is. Maybe somebody can help me with it. But how does it start? Is it be fearful if people are greedy? That one? Definitely there's that. And it's, be fearful when others are greedy and greedy when others are fearful. Also a Warren Buffett quote. Yes, yeah. Ironically. And so there's plenty of people out there that are fearful right now. We'll see how it ultimately plays out. But again, that's why you're working with an advisor. You have a plan in place. Shouldn't worry about what the market's going to go off or going to go down. Typically, those are assets you're not going to touch for 3 to 5 years anyway.
You're still bullish on equities, even though like the PE ratios are running around 22?
100%. So valuation, while a great metric, actually has a very low propensity to being right over a short-term time period. So we've ran the analysis. So if a stock hypothetically is expensive today relative to its 20-year, 30-year, or 40-year average, its probability of underperforming based off it being expensive in the next 12 months is extremely low. The correlation is almost 0.00045. Like, it's very low. It's not until you extend it out 20 years to look at something like, let's say, hypothetically, a company's expensive today, and we look at it now 20 years later, how did it do? Because of that valuation, it becomes only a 0.45 correlation. So it's still not statistically significant, or depending on how you look at it, but it really becomes more important to consider when we're looking at long-term allocation. I would also say, historically too, until very recently, we've also had no other alternative. That's another acronym that we use in this industry, Tina. There is no alternative. And by that, I mean, for a very long time, bond yields were yielding what? Almost zero. So the only option you had was to move into the equity markets. We'll see what happens. We're still sitting on about $1 trillion of that $2+ trillion that we had accrued during the pandemic, us as consumers, that's sitting in money markets today. It'll be interesting to see if that actually goes to bonds, because they are paying something today, or if it goes to stocks. Another interesting statistic is that over the last 100 years, our average annual increase in money supply is about 7%. I always tell people, if you believe in a better tomorrow, or you're going to invest in a better tomorrow, whether it be for your family, the kids, your friends, whatever, market's a great place to be, and a lot of that money gets pumped directly into the equity market. So I would say, is there some concern? Probably something we're watching. But on the other side of that, one of the most popular things that we look at is the price to earnings ratio, or the earnings. And earnings have been increasing like crazy. Just for the Magnificent Seven corporations, these are companies like Microsoft, Amazon, Meta, Tesla, NVIDIA, Google. I'm missing a couple. Apple, thank you. I mean, they've increased their earnings 45% over the last 18 months on average. I mean, truly incredible. Additionally, what you're starting to see is spending coming online from a few policy packages passed back in 2022 in July and August. The Inflation Reduction Act, as well as the CHIPS Act, respectively, that are the spending kicked up this summer. That spending is going to increase from about $65 billion this year to about almost $100 billion next year to about $120 billion the year following. And these packages are really helping the other 493 corporations. So if you look at actually Q3 return for the first two quarters of the year, so the first half of the year, January through June, growth outperformed value by a lot. In the third quarter, value outperformed growth. One of the big reasons is valuation, some more money to be able to come in there and not pay as high about full for those. A lot of the spending from those is really benefiting the areas of their corporations. I would tell you going forward, I still anticipate the what's worked will continue to work despite valuations. Look at the S&P 500. 7 out of the top 10 of those companies are growth companies, the Magnificent Seven. So anytime anybody puts money to an S&P 500 ETF, which is the most popular ETF there is, by the way, 7 out of those 10 are getting $5, $6, $7, $4 per that 100, while your value companies are only getting $1.20, $1.30, which is JP Morgan and Berkshire Hathaway. So as long as the flow to passive management, as Warren Buffett says, which is a great thing, it gives people who don't have a lot of money access to the markets. Wonderful. As long as that continues, the continuation of what we've seen over the last decade. And keep in mind, these Magnificent Seven corporations, these is just an extension of the defanged stocks, if you recall those, which is the same companies, Facebook back in the day, Apple, Amazon, Netflix was the index then, Google, etc. It's the same things that we've been talking about for the last decade. There's one other, sorry, I know I'm going on a diatribe for your question, but hopefully it's additive. JP Morgan put out a chart going back to the 1980s saying if you invested just on any day randomly going back over the last 40 plus years, what your average return looked like, and it was really good. It was like 8 to 9%, right? However, if you invested in an all-time high, it was actually even higher. So there's a propensity, look at how many all-time highs we've had this year. It's north of 20 all-time highs that we've seen this year. When we hit all-time highs, the propensity is typically to go higher from there. And especially as we're developing more and more of these algorithmic trading models, we're going to continue to see that going forward. So just because valuations are expensive does not necessarily mean underperformance. Sorry for the long-winded answer.
Do you believe cryptocurrency is here to stay? And if so, should it be part of your portfolio? And do you recommend actual, even in cold storage in a wallet or something more at a ETF?
Good question. Personal preference there, but let me take a step back and show my bias real quick. So Fidelity has been in the digital asset space for a long time, maybe 10 years. Fidelity is a top 5 asset manager. We're also a privately held company. So we're not going to invest in things that could potentially lose us a heck of a lot of money if we didn't believe in them in the first place. And additionally, we can invest for a long period of time, knowing that it might take a while for us to see the fruit of our labor. So yes, we do see that digital assets going forward will be a part of the conversation. There's a lot of research as to how much. I can actually follow up with a piece that Eric and Tyler can get over to you that talk about that. But let's look at somebody who does not allow any of their financial planners, and I'm sorry to think you say how, but doesn't allow any of their financial planners to invest in the digital asset space. Bank of America, Merrill Lynch. So they do not. None of their advisors can invest in any of the spot ETFs. They can't invest in the stuff directly. And they did a report. This is maybe a month ago, looking at anybody above the age of 44 and anybody below the age of 3. Above the age of 44, so they only wanted out 1 to 2%. Below the age of 44, it was about 15%. Dramatically high. One of the reasons why we think it's going to be around because the use cases. Bitcoin was the first to market. It's probably going to be around for a long time. A lot of people compare it to digital gold. We can go into that if you'd like. Ethereum is another one that has gained a lot of popularity. It was really like the second to market, if you will. Think of Bitcoin as a digital gold. Think of Ethereum as like Amazon Web Services. You could build whatever platform or business you want to on Ethereum's platform itself. And in our opinion, this will be a wrap. Today, as it sits, there's over 4,000 coins in that space. Many will fail. I saw they found the guy that, they found his suspects on the shooting of the United Health CEO Ryan Thompson recently, and within 12 hours they will actually coin that as a lot of that stuff is going to be nefarious in nature, maybe a joke, if you will, had no merit, but there are some that will. I think depending on your overall portfolio, that's why, again, so important to work with an advisor to figure out what it looks like within the broader context of the portfolio. So many people have thrown $1,000, $5,000, $10,000 at it just to see, hey, speculative money, whenever. If I make some money, great. If I lose money, whatever. Doesn't matter. Well, a lot of people have made a heck of a lot of money doing that, and they still treat it as a speculative investment. If you made any money at all, even if you can't incorporate it as a part of your portfolio, you should bring it up to your advisor to make sure you're at least including that as a part of your overall portfolio construction process and a part of your overall risk scores. So to answer your question very simply, yes, I think it's going to be around for a while. Fidelity's invested in that space for a long time. I think it continues to grow. As we get the next SEC chair, they seem to be a little bit more pro on the digital assets case. I think there's some great technologies underlying. So for instance, everybody, we're buying a house right now because I'm a crazy individual. But we had to send a wire transfer from Bank of America to our title company. Bank of America is literally 100 yards from my house. Title company is here at DTC across the street. I had to pay a $45 fee for that to take place just to say I'm not going to go across the street, get a check, and take it over to the... That's ridiculous. 5 years ago, somebody transferred $500 million of Bitcoin internationally to somebody in London. If you do it the traditional way, like I did it, those funds are not accessible for at least 2 to 3 business days. Not only were they immediately accessible, it also took the cost was the fractions of a big. So a lot of the underlying technology can disrupt some of the more inefficient fees that we're paying today to transfer assets. So I do believe it's going to be around for a while. If you're thinking about either allocating to it new, or if you've been allocating to it, bring it up to your financial advisor so you can have that discussion as to what that looks like and what's appropriate. Because as you've all seen, I think a year ago it was trading at, or maybe 18 months ago, 14,000 Bitcoin, and now it had passed 100,000. I think it's below that now. But so anybody that's gotten into recently is maybe a lot of they should stop looking at it as a speculative investment and more a part of their well-rounded financial profile. So you're a customer.
What's your opinion on Rob Darnell?
I think they make sense depending on the situation.
Do we modify that question? What's your opinion on Bernie? Too wrong.
So again, work with your advisor on that. I think I know once the Harris administration was looking at getting rid of the Roth conversion ability to potentially give the government more money down the road. I think it's I think having options is always a good thing. Work with your advisor to figure out if it makes sense for y'all. That's what I would say. Just not give myself too much trouble on it's a customized discussion. So,
question. I think what I hear you saying is partly cloudy on a intermediate term, or at least positive in general. My biggest personal concern, a bit longer term, is government spending at debt and $2 trillion deficits, or as far as the eye can see, and off balance sheet debt for Social Security, Medicare of $100 billion potentially. At some point in time, we're financing this all by borrowing more money from somebody, be it China, be it other places. At some point in time, we're inevitably going to be in a very difficult situation because $1 trillion of interest is going to go in trillion, doubling to more. And so I think the intermediate term looks not only fairly positive, the long term looks like there's an elephant in the room that's got to be dealt with. And And neither the Democrats or Republicans are doing anything more than kick the can down the road.
What do we know about politicians? They're not going to take care of it until they have to.
Yeah. So what is your overall, and that is more of a bit of a long-term situation. 5 years, 10 years, whenever the music stops playing, I'm like, I panic.
Yeah. So a few things. As a constituent of this great nation, I'm concerned. As an investor, I'm nervous. The best way to look at your debt that you have is not necessarily by looking at the overall debt, right? The 35 trillion, whatever it is today. Because we look at that, we all think it's a magnificent number, right? It's incredible. And it is. Again, but rather than looking at that, look at one's ability to service said debt, right? If I live next to a billionaire, he got $500 million in debt. To me, that looks like a heck of a lot of debt. But to him, if he's able to service that debt, what does it matter, right? So the way that you do that on an individual basis is look at your debt to income. How much money am I bringing in versus how much debt do I have? Am I able to service that? Corporations do it debt to EBITDA, earnings before interest, tax, depreciation, and amortization. The way that countries do that is debt to GDP. So as it sits today with our $35 trillion in debt, we're currently at about 105 to 110% debt to GDP, excluding the unfunded liabilities of Social Security and Medicare. When you include those, we're about 135% debt to GDP. Now, you can't just look at that. You also have to look at that relative to what? Let's look at the other developed countries. Broader Europe, for instance. Some of those countries that are over 150% debt to GDP. The lows are about 136% today. Japan's over 200% debt to GDP. China's 250% debt. It's not just a U.S. issue. It's a global issue. Now, looking at that, you might say, okay, well, we're still the cleanest, dirtiest shirt, right? I mean, it's not a great place to be. But from an investment standpoint, I'm not overly concerned because of it's not just a U.S. issue, it's a global issue. I would encourage you, there's a book called Debt the First 5,000 Years. It's an anthropological look at the history of debt. What we don't realize is debt precedes written language. It's been around for forever. And this is not the only time in human history that we have seen numerous parties being so out over their ski tips from a debt standpoint. Historically speaking, what would you name? Bob, what's the question? Historically, what we've seen, Bob, whenever things get out of control, and I promise you they're going to get a lot more out of control than in control, debt gets forgiven. Because not only do people hold our debt, we also hold other people's. And as it sits today, the U.S., relative to any of the other developed countries out there, we're the best looking thus far, which is why you continue to see demand for our debt getting so elevated. Here, I don't have access to internet, but just to prove a point to you, picture yourself as an insurance company or as a sovereign wealth fund. So this is like a rainy day fund for like Saudi Arabia. Think of yourself as a huge pension and endowment. Huge, hundreds of billions of dollars, right? If we invest across the Treasury yield curve, you and I, we're not moving the market at all. It's those huge institutions that move the market up or down. So you really have three options, despite where you are in the world, to invest in something that A, you know you're guaranteed to get paid back on. And secondly, you actually want to make a little bit of money. A lot of these endowments, foundations, pensions, insurance companies, they have these long-term time horizons. So a lot of that is equities. But they also need to keep enough cash on hand and reduce their liabilities. So they'll do that by, we have this liability coming up in 3 years. We're going to invest in the 3-year treasury, and we're going to invest this amount a month to offset that in the future. They'll do that over the 3, 5, 10, etc. So your three options in terms of countries that A, guarantee to pay you back, and secondly, will actually pay you something, it's us, it's Germany, and it's Japan. Yeah, nobody here is as big a nerd as I am, I hope, and has looked at the German bond market or the Japanese debt market recently. But the 10-year debt for the Japanese market is currently around 23, 26 basis points. The Japanese market's around 2%. Anybody look at what our 10-year treasuries yield be today? It's about 4.15, 4.2, somewhere in that range. There's not a better place to go And you would have to explain to shareholders why you're taking at least a 2% haircut to invest anywhere else. Which gets to a couple things. Number one, as until that changes, which it's not going to change anytime soon, probably in my lifetime, it will not change. And that's going back to your question. As a constituent, I'm concerned, but I'm not going to have to answer for it. My kids are probably not going to have to answer for it. It's my grandkids, my great-grandkids. We will indirectly, but we won't know it because it's opportunity cost. Money that we should be spending elsewhere to grow our country is being spent on debt service obligations. But anyway, as long as that holds up, not only will demand for our debt be very attractive, and even go back, this isn't something new. This has been the case for at least 25, 30 years now. So as long as these differentials in yield continue to be, as long as the dollar is the world reserve currency, which again, that's not going to change in our lifetime, you're going to continue to see demand for our debt, which means that we're probably going to continue to kick the can down the road, borrow more, and and not address it. So again, as a constituent, concerned. As an investor, not at all. We're still going to see great returns for risk assets. We're still getting great returns for fixed income today. It's a great time to be an investor. The best time to be an investor, really, over the last 25 years. Please. Getting a lot of questions from this side of the room. I'm going to come stand over there. I don't need it. Please.
Question on competency. We are proposing what seems to be a number of asset positions that have no skills, no experience in the areas that we're going to step into. What do you see the risks of huge estates being made to destroy our economy?
To destroy the economy, very low. I get your concern why we're putting people in charge who maybe don't have the background, who don't have the experience. And don't forget, we have a number of different systems in our government. We have the legislative, the executive, the judicial. Really, the power of the president is it's pretty minimal overall. Their goal is not to screw anything up so dramatic. It would take an awful lot to screw something up in a very dramatic fashion. I mean, heck, just look over the last 100 years. Navigating 2 world wars, many different wars going on overseas. There's been plenty of opportunities for people to screw that up, and we haven't yet. I think that there's some merit in being concerned about the individual departments. However, there's definitely a balance of power that keeps a lot of anything that could derail our system from going astray. I have confidence that 4 years from now, I don't know where we'll be, but the U.S. will still be the superpower out there. That's going to be the case for the next 20 years. These things just typically happen, and it's going to be very tough for anybody to test us on that. Because to test us, well, we can get into that, but I understand your concern, but I'm not concerned for the future of the United States. I know that's like more of a, here's Rob's thoughts rather than to his actual but again, like there's been numerous times of past where people have questioned, why is this person doing this or putting this person in charge? And what we find is that the amount of power that these people have is typically more limited than maybe what it appears to be.
How do you see the future of U.S. relationship with China?
Fidelity können Sie das proper? Well, it depends on what China we see going forward. Because it doesn't matter what Trump we see. Trump's going to be gone in 4 years. Right? It depends on the China that we see. If we get to China, again, reminding us how communistic they are 4 years ago, who took a lot of the wealth and redistributed and made it less of a capitalistic society. The problem with China is that they're very reliant upon trade with other partners. So like the U.S., we are such a blessed organization in the sense, a country in the sense that we derive our growth. You and me deciding to go out and spend money rather than staying at home and saving money, that's 70% of our GDP. It's essentially the opposite for China. Almost 50% of their GDP, exports. They need people to buy their stuff. So everybody laughs about the sanctions that we put on Russia a few years ago, did almost nothing. You put those sanctions on China, it's going to impact their growth moving forward in a dramatic fashion. Don't forget, they also wanted to have by, I think it's 2049, it was their end of the 100-year plan where they become the global hegemon. It's going to be very difficult for them to do that. Not only do they have a huge population issue, we think we're getting older, they're even older than we are. Remember the one-child policy that they had instituted for so long? They finally gave that up, and they're trying to incentivize more creation of kids, but it's not happening. They also have an unemployment rate right now for the 22 to 44-year-old crowd, both male and female, that's north of 15%. They have a huge debt issue taking place over those. They need help from the outside parties. If you saw recently, they're trying to tame down some of the war that's taking place between Russia and Ukraine by sitting some of the drone configurations, hoping for some sort of resolution. I mean, we'll see what happens there. But the point is they need help of others. I think they're going to be able to come to the table in a much bigger way than maybe they were in 2016 to 2020 from a negotiation on tariff standpoint, because they're at a huge deficit today from a trust factor for the global nations. Should have been for a long time, by the way. Going back to like Henry Kissinger days, it was Goldman Sachs and Morgan Stanley that taught them banking. We taught them banking, and we said, hey, just make sure you don't do these 2 or 3 things that's really corrupt. Just don't do that. They said yes to our face, turned around and did exactly what we told them not to do. They have a huge history of doing this. The problem today is that ever since COVID, ever since the way they handled COVID and President Xi, he's also got a very low approval rating, if you will. We go over there and talk to farmers. We talk to, because one of Fidelity's headquarters is in Hong Kong, so we will jump over to China as well and meet with business owners, farmers, even some policymakers. Policymakers always buy the script, almost say the exact same thing. Where you really get the information is the small business owners and the farmers, and they're not happy with what's going on over there. So for China to be successful, they need their constituents to be on board, and they need global relations to be a heck of a lot more positive than they have done in the last 4 years. So I think it's actually going to be more amicable than what many people anticipate, because they need that. If they want to hit that 2049 goal, which I don't think they will, they need to come to the table in a way more amicable way. It's in their interest to do so.
Where do you see, mentioned the magnet 7 or they're growing and in reinvesting. Where do you see the future of AI? A lot of time. It's a Fed thing.
Just going out with Bitcoin. So I think it was Nobel laureate economist Paul Krugman that said the internet's going the way of the fax machine. It'll be irrelevant in 10 years, back in 1998. I think AI is very similar to 5G technology. We sat down with the CEO of Verizon. This is about 3 years ago now, before 5G was available as it is today. It was way more bespoke and tailored to the environment, only available in select areas. And we asked him, what's the impact of 5G going to be? And his response was, I'll tell you in 20 years, because truly you have no idea. You have some general impacts of what it could do, like autonomous driving. It makes that doable, attainable. Similar with AI, I know it's going to be able to help a lot of industries. It's also going to hurt other industries. Not too worried about that. That happens across, look at history. I mean, we used to have a ton of cobblers, a ton of ironsmiths. We don't have those as much anymore. So we have natural transitions of jobs that come as well as go. But where it goes moving forward, I think we should be very optimistic, a little bit worried because the technology is incredible. IBM came out recently, because of AI, the ability for us to have quantum computing power in the households has moved forward like 15 years. Like by 2030, quantum computing power in your house. You can't imagine that. Having things done, very complex things which would shut down a computer that's running off of the highest brand today would shut down just to do a fraction of what these quantum computers can do. Additionally, some of the things on the other side, it's also pulled up the time frame of when artificial intelligence, or at least the estimates have said when it can be sentient. So like understanding, like more feeling. It's a very broad question. I think there's a lot of pros, a lot of cons. You're going to see a lot of profitability come from it. A lot of really good things come from it. However, we got to continue to monitor it going forward. I would tell you, just as it relates to investments, Fidelity believes the next NVIDIA is NVIDIA. They're so far ahead of the competition as it relates to chip production. and the subscription that you have to have, like the first chip to buy the second chip that they just came out with. It's going to be a very long time before we see anybody sort of come to market to compete with them. Not to say that their earnings are going to continue to go up as they have, and share price will, but in terms of market leadership, they will still be prominent for the next 5 years at least. There's a lot of impacts. I think there's a lot of good. There's a lot of efficiency, a lot of profitability that's going to be driven. There's also going to be some threats, and we need to make sure we're at least monitoring those and making sure that nothing happens too quickly. I think we're well behind to have that specifically regulated from a government standpoint. So I know that doesn't answer your question. A lot of good things, a lot of bad things.
So a good short term.
Yeah. Oh, 100%. 100%.
Yeah. Does AI require truth for being able to tell what truth is? Well,
Obviously not. We've seen that thus far. Yeah. It's all dependent upon, data in. So whoever is setting up that data, whatever their biases are, typically comes out in the output. So over time, what we will see is we'll see that being rectified. Now, the question is will we be able to notice it? Like, it's very obvious and apparent right now. Will we be able to notice it? I'd say here's fine. We're probably doing AI sponge. Yeah. Like it. So,
Facebook.
You think deglobalization will result in significant onshore investment opportunities?
100%. It's already happening. Look at just what's happened since COVID. So much manufacturing has moved out of China and has really helped a lot of the surrounding Asia Pacific countries. But not only that, it's helped Mexico, for instance. Mexico's doing very well right now. Brazil is another place that's done very well for. Keep in mind, though, that's a very good thing for American productivity, American manufacturing, jobs. Bad aspect of that, inflation. It costs more money over here to produce things, right? I sure as heck am not going to go do something for $3 an hour like somebody else in another emerging market nation. None of us. So wages just in general is going to increase that cost. Also, to build things here costs more. There's a lot of regulation depending on where you build. California alone, you need a ton of permits, which costs a lot of money just to put concrete in the ground. Like, it's incredible. So yes, that's going to continue to happen. I think the study was that there was 5,000 businesses surveyed in 2021. 83% of them said that they were planning on either had already started or were planning on bringing production back to the U.S. But keep in mind, while a good thing, also it's going to be inflationary, keeping interest rates higher, keeping growth going on longer. But if you're, upset about spending more money at the grocery store, I don't think that that's going to go away anytime soon. So definitely an investment thing that we're focused on. I'm sorry I didn't bring it up, as it's one of our big benefits for the consumer going forward. We finally hit it. What did we not talk about that we should have? I hope you'll join us. Next quarter? Are we doing religion?
I don't know what.
Yeah,
Yeah. Well, look, I'm sticking around. It was so nice to informally meet all of you. Thank you so much for the opportunity, for allowing me to speak today. If you have any other questions, let me know. But y'all are working with a fantastic group. I get to work with, I think there's 10,000 different advising groups that I work with holistically. These guys are some of the best that I work with. Truly people that I love and care for. And that's very rare in this industry. So Eric, Tyler, everybody, part of RWP, thank you so much for having me.